On the surface, it looked like the cleanest way to punish a nuclear power without starting World War III. No NATO troops, no missiles, just code and cables. In February 2022, as Russian tanks crossed into Ukraine, Western leaders reached for a weapon the public had barely heard of, but bankers feared: SWIFT. Headlines called it the financial nuclear option. Overnight, major Russian banks were cut out of the main messaging system that connects more than 11,000 banks in over 200 countries. TV anchors said Russia had been kicked out of the global economy. Crowds cheered, politicians boasted. But almost nobody asked the bigger question: if SWIFT is the wiring of the global dollar system, what happens when you turn the wiring into a weapon? Because that day, something else cracked. Not just Russia's access to finance, but the illusion that the dollar-based system was a neutral piece of plumbing you could always rely on. To understand why that matters, you have to understand what gave the dollar its power in the first place. It wasn't just America's GDP or its military, it was trust. Trust that if you parked your reserves in U.S. Treasuries, they would be there tomorrow. Trust that if you paid or got paid in dollars, the transaction would clear. Trust that SWIFT, the Belgium-based cooperative that sends payment messages, would faithfully deliver them no matter who you voted for or what your government did. That trust is why countries that hate each other still clear trade through New York, why oil is priced in dollars, why emerging markets borrow in a currency they don't control. The day Western governments used SWIFT to cut off a G20 economy, they told the world, without meaning to, that access to that system is not purely technical, it's political. And once you learn your life support can be shut off for reasons beyond your control, you start planning for a different machine. The irony is that SWIFT itself doesn't move a single cent. It's just a messaging network, a standardized language banks use to talk to each other. Debit this account, credit that one. But because the vast majority of global trade and finance is denominated in dollars and euros, and because those flows eventually touch Western correspondent banks, controlling SWIFT is like controlling the nervous system of world money. For years, the United States only hinted at this power, pressuring banks behind the scenes, threatening fines, cutting off smaller rogue states like Iran and North Korea, whose economies were tiny. Those were warning shots. Cutting off Russia, one of the world's biggest energy exporters and a key supplier of commodities, was different. It showed that if you are on the wrong side of Western foreign policy, your banks can be unplugged from the main grid. That may have hurt Moscow, but it also sent a shockwave through every capital that has ever worried about Washington's mood.
In Beijing, Riyadh, New Delhi, and Brasilia, finance ministers and central bankers watched the SWIFT cutoff with a very different emotion from Western TV audiences. It wasn't triumph, it was alarm. Not because they supported Russia's invasion, but because they suddenly saw their own vulnerability. If a G20 nation with nuclear weapons and massive commodity exports could be partially unplugged from the dollar system, then no one was truly safe. The message was clear: your access to the pipes of global finance depends not only on market rules, but on geopolitics. That realization flipped the logic that had sustained dollar dominance for decades. Before, the safest move was to hold dollars, settle trade through Western banks, and integrate yourself deeper into that system. After Russia's cutoff, the safest move became use the system while you must, but quietly build ways to live without it. You can see that shift in what happened next. Russia, already sanctioned since 2014, accelerated the use of its own financial messaging network, SPFS, as a backup to SWIFT. China promoted its cross-border interbank payment system, CIPS, more aggressively. The two started linking their networks so banks could route messages in yuan and rubles instead of dollars. Russian energy exports to China began settling more in local currencies. India started buying discounted Russian oil and exploring rupee-based payment arrangements to avoid Western scrutiny. The BRICS group began talking more openly about building alternative reserve arrangements and even a joint unit for trade settlement.
Meanwhile, central banks across the non-Western world quietly bought gold at the fastest pace in half a century, trimming the share of U.S. Treasuries in their reserves. These aren't overnight revolutions. They're slow, structural hedges, the kind you build when you believe the old anchor may not hold forever. For the dollar, the danger isn't a sudden mass exit. The danger is gradual loss of compulsion. Dollar dominance rests on two pillars: that the dollar holds value and that dollar infrastructure treats you fairly, even when politics are tense. Inflation and money printing stress the first pillar. Weaponized payment rails attack the second. Once enough countries decide they cannot fully trust those rails, they start to route around them, first for sensitive transactions, then for energy deals, then for bigger chunks of trade. Each workaround is tiny in isolation. Together, they slowly reduce the world's automatic need to hold dollars in U.S. debt. Think of it like erosion. No single wave destroys a cliff, but wave after wave, the rock recedes. The swift cutoff was a storm that told everyone the waves are now aimed not only at your enemies, but potentially at you.
The most important thing to understand is that this erosion changes behavior long before it shows up in charts. Official statistics still say the dollar accounts for the majority of global reserves and trade invoicing. That won't flip overnight. But behind those numbers, decision-makers are already acting as if a different future is coming. Energy exporters are quietly signing long-term contracts in yuan and other currencies. Regional blocs in Asia, Africa, and Latin America are experimenting with local currency settlement platforms. Multinational companies are opening more accounts in alternative hubs like Shanghai, Dubai, and Singapore, so they can route payments away from New York if they have to. Every time they do this, the network effect that made the dollar unavoidable gets a little weaker. What used to be "we must use dollars" becomes "we mostly use dollars" for now. From Washington's perspective, cutting Russia from SWIFT felt necessary. Domestic voters wanted a strong response that stopped short of open war. Financial sanctions were the cleanest visible tool. But geopolitics runs on different timescales. Politicians think in election cycles. Civilizations think in decades. The people running rival powers watched the sanction, watched the freezing of Russian reserves at Western central banks, and drew a simple conclusion: no reserve asset is truly safe if someone else's government can freeze it. No payment network is neutral if someone else's politics can shut it off. So they began, more seriously than ever, to plan for a world where the dollar is just one currency among several, where SWIFT is one highway among many. They won't say this on stage at Davos. They don't have to. You can see it in what they're building. Did that one sanction kill the dollar? Not in the Hollywood sense. The dollar is still the deepest, most liquid market. Treasuries are still the global benchmark. But February 2022 marked something subtler and more permanent: the day the world stopped believing that dollar infrastructure sat above politics. Once that belief is gone, every rational government has a duty to diversify. Over the next decade, that means more trade in non-dollar currencies, more regional payment systems, more gold, and fewer treasuries in reserves. For ordinary people, the change will be almost invisible at first. No sudden crash, no headline saying "dollar era over." Instead, you'll see more news about bilateral deals outside the dollar, more talk of multipolar finance, more countries refusing to obey U.S. sanctions because they finally have another bridge to cross the river. When historians look back, they may say the day Russia was cut from SWIFT was the day the dollar's dominance started to crack. Not because Russia was powerful enough to break it, but because the rest of the world realized they could no longer afford to bet everything on a system that might one day be used against them.
For you personally, the question isn't whether the dollar collapses tomorrow. It's how you live and invest in a world where its dominance is no longer guaranteed, and where every crisis pushes more countries to test the exits. Most people will ignore this until it's obvious. They'll keep thinking of money as something neutral, something separate from power. They'll assume that because they get paid in dollars and pay bills in dollars, the rest of the world will always be forced to do the same. But you've now seen the other side. You've seen how a tool like SWIFT, sold as boring infrastructure, can suddenly be turned into a weapon. How that one decision reverberated through central bank vaults, energy deals, and quiet meetings on the other side of the world. The smart move isn't to panic. It's to update your mental model. The map you were given in school, $1 world forever, is already out of date. So what does updating look like? It means recognizing that risk-free U.S. assets carry a new kind of risk, political risk. If you live outside America, holding all your national savings in dollars and clearing all your trade through dollar pipes makes you hostage to someone else's foreign policy. That's why your central bank is probably adding a bit more gold, talking to neighbors about local currency swaps, and exploring regional payment schemes. If you live inside America, the risk is different. The privilege of issuing the world's reserve currency has allowed the U.S. to run deficits and export inflation for decades. As that privilege erodes, financing those deficits gets harder. That can mean higher long-term rates, more pressure to tax or inflate away obligations, and a slower, grittier version of life than the post-Cold War boom suggested. None of this is destiny, but it's the direction the incentives point. You don't control SWIFT, you don't sit on a central bank, but you do control how blindly you trust systems that can be repurposed overnight. Diversification stops being just a slogan on a brokerage website and becomes a survival principle. Diversifying where you bank, what currencies you hold, what assets you rely on, even what skills you can sell across borders, these are all ways of quietly stepping off the most vulnerable parts of the grid while the lights are still on. At the same time, understanding this shift helps you see through the noise. The next time you hear a politician demand that some country be cut off from the global system, you'll know there's always a second target, the system's own credibility. In the end, the day Russia was cut from SWIFT won't just be a footnote in the Ukraine war. It will mark a hinge point in monetary history, the moment the world saw the dollar's wiring as a potential trap, not just a lifeline. From that moment on, the clock started ticking a little louder on a transition that was always coming someday.